Well, stocks sliding in today's trading session after Fitch downgrades the U.S. government's credit rating. So what does this mean for investors? Joining us now, I want to bring in John Stoltzfus. He's Oppenheimer Asset Management Chief Investment Strategist. John, it's great to see you. So ahead of this downgrade, you raised your year-end target for the S&P to 4,900 from 4,400. This downgrade from Fitch, does this change your view at all?
Not at all, Shauna. And in fact, and I know we've had a large flow of information from economists from around the street throughout the day. When we think back of the downgrade, I guess it was Moody's in 2009. There was a lot of drama initially around it until it's just realized that people don't buy the U.S. Treasury because it's AAA rated. There generally aren't mandates among managers that they have to buy AAA rated government paper. And already, as a result of the earlier downgrade, it wasn't all AAA rated because Moody's didn't have it. So, the market's a lot higher than where it was in 2009. My recollection is at one point in 2009, the S&P 500 was at 676, and it took years to get back to 1535, as I recall, which was the October 12th, 2007 peak of the S&P 500. So it's not an issue. We really think the main thing is we got to see the economy keep growing in here at a modest pace. Jobs to remain, resilient, the consumer resilient, business able to navigate the current scene. And essentially, the Fed being very sensitive about the way it's raising rates over 11 times, bringing down the headline number down by about 2/3. Now, with a little bit of trouble on the core, where it's still, what it was, the headline is 3%. It dropped 3%. And then you got, rather was at a level of 3% up. And the core was up, 4.8 or something like that. So that's, a distance away from the 2%, but we're progressing nicely. And stocks are reflecting that.
So we saw private sector companies adding far more jobs than expected in July. The ADP employment report pointing to strength in the labor market. What does this mean going into Friday's jobs report?
Well, when we think about Friday's jobs report, based on what we've seen over the course of the last few months, it's fairly steady. It looks to us like you're going to see a fairly strong number. The consensus number is likely to carry in this situation at around 200K. You're going to get a slight uptick on the wages, but overall the level of inflation's growth has been coming down, and you've got the economies moving at a slower pace. The increases in the inflationary aspect is softening, and it looks like we may very well be able to skirt a recession. We've said that, by the way. If you go back to our pieces that we wrote last December when we put in our 4,400 target, which at that time was, I think, second highest on the street. Now we're at 4,900. Last I looked, I think we're the highest on the street for the end of this year. We were looking for the likely a bumpy landing at worst, and maybe the possibility of skirting a recession. And we've believed the Fed. We're big students of the Fed. I got into this business in 1983, so I've had to work under the effects of Volcker, the effects of Greenspan, Alan Greenspan, and then Bernanke, Yellen, and now Jerome Powell. And the Fed is much better than it ever has been at communicating since Bernanke. This is the Bernanke legacy under Powell.
But John, can't you make the argument that the market is hearing what it wants to hear from Powell? Because Fed Chair Jay Powell, he did say that they are leaving the door open for another rate hike. Yet when you take a look at the Fed fund futures, less than 20% of traders see a hike at the September meeting, and not much more see a hike at the meeting after that. So are they reading it right, or are they still being a little bit too optimistic?
Well, I think traders will be traders, and the Fed will be the Fed. I think the Fed is being straightforward, and the traders are placing a bet on it. But we've seen before, going into the last the most recent hike here in July. My recollection is leading up to that, there was a lot of opportunity to see, there was a chance, I think, that they wouldn't see a hike. And of course, the vast majority of them expected a hike. It came in where it was expected. I don't think it's much of a concern here unless the Fed would do something drastic in terms of an uptick in cuts, uptick in hikes, or if it were to cut, I think the market might be absolutely stunned, and I don't think that's going to happen. I think, they may skip September. I think there's a real possibility of that based on what we're seeing right now.
So let's talk about how investors should be positioning themselves. In the expectation, it sounds like that the Fed will likely skip come September. Where do you see value right now?
Well, we continue to see value in industrials. We've liked the industrial sector now for years. It's well positioned in the area of power generation, whether it's alternative or whether it's traditional things for fossil fuel that carries the bridge into the alternative era. And then in addition to that, it's aerospace, it's defense, it's robotics, it's all kinds of sensors and things that make industrial equipment more efficient. In a period where we've got this huge infrastructure bill, we're going to hopefully see the money start actually be meeting the road, and actually moving things in terms of building the infrastructure. And then you got the CHIPS Act. And we think the industrial sector is very well placed. We also continue to like profitable technology that's deeply embedded in the lives of both business and consumers. And we continue to like the consumer discretionary, because the American consumer is a very tough consumer to bet against, because when times are flush, they spend like sailors who have just been got off a long tour of duty. They'll spend money pretty wildly, but when times get tough, they become much more discerning about what they spend, where they spend it, but they keep spending because the American public, as a consumer, vindicates or validates their existence in many ways, just by the fact that they can still buy something.
All right, we will see whether or not the consumer holds up if we do see any sort of pullback here. John Stoltzfus, great to have you sticking by 4,900 target on the S&P by year end.